I titled my last MIF presentation, Nobody Knows Anything. I still think nobody knows anything, honestly, but given how the markets have been the last month, the question everybody has asked is, how bad does it get? I will quickly jump back to the nobody knows anything, but I've got a few ideas about how I think this will play out. The problem I've got, and I've had this problem, everyone's had this problem, honestly. They had it 3 months ago. It got significantly worse once Ukraine war started. But there's really 2 or 3 pretty divergent ways things could go from here. And I would say there's really no, I don't strongly favor any of them. I mean, it's really a coin toss, honestly. And it's one of these situations where we're probably not going to get a lot of super useful data up front that's going to tell us which way it's going to go. We're going to find out when it happens. It's just that kind of year. Basically, really, what happened, like 2 months ago, I was sending stuff to subscribers going like, it's really weird to me that the markets aren't more nervous about all this stuff. Like, what's going on? Like, why isn't the way the bond yield, the yield curve is shifting and all this stuff? Why isn't it freaking people out? But I commented back then, I said, the thing with things like the yield curve is they don't matter till they matter. You wake up one day and suddenly everybody's focused on it. And that's kind of what happened here. And, I wrote about a month ago that what really seemed to do it was Powell's comments in an interview it was about 3 weeks ago, where he basically made comments about how much he thought the employment market was overheating. And the use of that phrase really freaked people out, because suddenly all the bond traders went, oh shit, he's going to do 75 points in May or in April. And you couldn't get people off of that. And that shift, and if you went back and looked at the yield curve, the bond traders going from like, now he's going to do 25 basis points, he might not do 50 to he's going to do 75. That happened in like 36 hours. Like when he made those comments, it totally freaked out bond traders. That's when the wheels really came off equities at the same time. So now, now we're at this point where, the Fed, who I'm sure they were, to be fair to those guys, they get blamed for everything, but I'm sure they were shaking their heads going like, what the fuck is it with bond traders? We've been telling these guys for 3 months. Like, we've got 2 mandates. The one we're worried about right now is inflation, period, period, period. Like, we've been saying that every day for 2 months. You totally ignore us, and now you're suddenly freaking out. But they have stayed on track with that. I mean, he did, at the last meeting, he took 75 basis points very definitively off the table, and that gave us a nice one-day rally. But he's also, he and all of the other FOMC members have been saying, look, it's going to be, 50 basis points this meeting, next meeting, probably the meeting after that, probably maybe the one after that, and then we'll see. So you're looking at another 150, 200 basis points, 1.5%, 2%. I don't see any evidence yet, although the markets are freaking out. I've yet to see any evidence of real slowdown in the economy, but of course that's what we're all worried about. If you look historically, basically central banks, not just the FOMC, but central banks in general, when they go through tightening cycles, their track record, their batting average, if you will, for doing a tightening cycle and not going one move too many and generating a recession, their batting average is about 250. One time in 4 they pull it off, the other 3 times things go into recession. That's why the market's freaked out right now, and rightly so. And if you look at what's happened in the last couple of months especially, I mean, it's hard to tell with these 2 charts because admittedly they're, unfortunately, the scales sort of equalized. That's what the program did. The Nasdaq chart, if you lay them out, is actually a lot uglier than the S&P one is. S&P dropped literally exactly 20% before it bounced the other day. Nasdaq is off about 30%, so it's definitively in a bear market. And that makes sense when you look at what drove Nasdaq for years. It was meme stocks, tech stocks with no earnings, and basically, fluff. And when you think about how the market is supposed to value things, which a traditional theory is of why our share prices what they are, the market is basically a valuation machine where it values all these future cash flows from now to eternity, dividends, earnings, all that. And if you're dealing with, so it works like a bond. You can basically take that information, which you're making up half the time, but you can take that information, plug it into a model, and it will basically value a stock much the same way as a bond would be valued, like, principal, future interest payouts and all that. And when you look at things like meme stocks and tech stocks, which essentially aren't trying to make money, they're really about growth, or in the terms of meme stocks, they're about whatever the hell they're about. You can think of those as being zero coupon bonds. And when you think about what happens in the bond market when interest rates move, the longer the duration, the bigger the move, and zero coupon, infinite duration stuff swings like a son of a bitch. So when the interest rates move either way, that's the stuff that moves the most. And basically Nasdaq is getting treated like a zero coupon bond. So when the market started pricing in 1%, 2%, 3% rate increases, Nasdaq got crushed. Is it done? Maybe. I don't really think so, honestly. I think we might be starting a bounce, like we might have started one Friday. We're certainly overdue. I mean, sentiment's horrible. It's like 100% bearish. Everybody's negative. We're all going to die. That's usually when you get a bounce. I'm not convinced. I'd like to tell you I think that bounce is going to hold and that Friday was the bottom, but I'll honestly be pretty shocked if that's how it turns out. At a minimum, if we get, say, a rally here over the next 3-4 weeks or less, I would expect it to test the levels it hit Thursday, Friday. And I would say it's 50-50 at best that it holds those levels. I would think Nasdaq's going to go lower still. If you look back at similar, and there aren't many, really probably the most similar situation was 2000, the dot-com bubble. It took a long time for that to unwind. So, and that's going to impact everything. When a big market like that's getting crushed, it's not going to help any of us. I mean, you don't get people going, wow, all of my Nasdaq stocks are down 80%. I think I'll go buy an exploration stock. Like, why not? FOMO, YOLO FOMO, let's do it. So I'm going to just go to this one. And this is really what's going to define things, I think, over the next few months. I think we all know this, obviously, is what's inflation going to do? Because what inflation is going to do defines really how hawkish is the Fed going to be. I don't know how readable that, it's not that bad. Essentially what that chart is the CPI, it's broken down into constituent parts. So, and you can see them along the top there. There's core month over month, there's services, goods, food, and energy. And if you look at the latest one where the CPI, headline CPI went from 8.5 to 8.2. You can largely thank energy for that because oil prices came off during April. Unfortunately, right now, that doesn't look like it's going to get repeated. Gasoline and diesel are both at all-time highs. So I think you can assume that little minus 0.22% that helped it drop isn't going to get repeated. I do think some of the other core items, we're getting into the period now where we're about a year out from the, if you remember that big jump in inflation a year ago that freaked everybody out, we're sort of getting to a year out from that. And what that means is we should see base effects. We should see smaller monthly percentage increases just because the denominator gets bigger. So because we're comparing it to the spike last year, year over year, it won't look as big. So we should see some moderation because of that. I'm highly skeptical we're going to see more moderation because of energy prices. We still don't know really what's going to happen in terms of how much Russian production is going to get stopped. We've got other issues on this side of the ocean because if you look at diesel and gas prices in North America, that's not really due to Russia. There's other supply chain issues. There's still supply chain issues everywhere. So I do think inflation might have topped last month, but I'm in the camp that says it's going to drop much slower than the market thinks. And if you look at this chart's basically a consensus. I don't think this pointer works, but let's give it a shot. Oh, it is. Oh, yeah. This is basically a Wall Street consensus chart. So this is, they just aggregated all the estimates from the big Wall Street firms. That's what those guys think is going to happen. And if you look at their forecast, it comes off pretty fast. You get to the end of the year and you're looking at core of about 2.2, 2.3. Headlines about 3%. That's a pretty big drop. I mean, some stuff is really going to have to drop in price for that to happen. I'm not sold on that yet. I mean, we'll see. And that, understand that consensus is the basis of how the bond market is valuing things. and what Wall Street thinks is going to happen, and why they think they may see a bounce here, because they think the Fed is going to actually get inflation under control quite quickly. The question is it a soft landing or is it a hard landing? Okay, of course it didn't keep the. Okay, I'll just tell you what that was. You've all seen it. I mean, if you're subscribers, you've seen it for sure. The chart that was in there is what bond traders call the chart of truth or the chart of God. It's basically a 40-year, 10-year yield chart, and it does this the whole way down. I mean, there's obviously cyclical things inside there where yields go up and down, but for the last 40 years, basically since Volcker finished raising rates, the long-term trend in bond yields has been down. Period, paragraph. Everybody who trades bonds everywhere in the world has never been in a market where that didn't work. So bond traders are still talking their book. They're still saying there's a scenario here, because if you look at the tail end of that chart, which you cannot see, you will notice that 10-year yields have actually jumped up above the channel that they've been in for the last 40 years. Is that, is that it? Does that mean the chart of truth is dead now? I don't really know. Honestly, back in 2019, this happened where it popped above it, and I thought that was the end of the 40-year bond bull market, but it dropped back down again. And if bond traders are right, and this is their argument, is we think the Fed's going to do one or two moves too much, they're going to generate a recession, and you'll see bond yields just crash down again, and the chart of truth will still be truth. I don't know, but I think 10-year yields, and if you just do a search, bond market chart of truth or anything like that, I mean, you'll find it. This is a very, very well-known chart. It's one to keep an eye on, because if the bond traders aren't right, if that is the end of the 40-year bond bull, it's going to change a lot of things. And there's so much tied into that chart, I can't even tell you what the long-term effects are going to be, really. I mean, it changes things like how projects get valued, long-term mortgage rates, credit cards, like everything, all of that stuff changes. We're back to the way things were 50 years ago, and it's going to take some time for the market to deal with that, because like I said, nobody in the market has any experience trading that kind of market. Nobody. There isn't a bond trader out there that knows what that market works, how that market works. And this is kind of an example of what bond traders have been doing. There's a yield curve a year ago. Here's the yield curve right now, the one in the middle. You can see it actually dropped down a little bit, flattened out a bit after the CPI report. And what that, basically what this is telling you, and it's important to remember this. I mean, everybody's freaking out about what's the bond market going to do when the Fed raises rates. I don't think the bond market knows, but understand the move from here to here with the yield curve shifting that much, the bond market has priced in what the Fed's talking about doing already. It's not like, oh my God, they're going to wake up the next Fed meeting and everyone's going to freak out. Bond market's already pricing in everything that Powell is talking about. The 3 or 4 50-point increases are already in the market, which is good news. I mean, I don't see the market overreacting unless it sees data that tells it, okay, Powell's going to get even more hawkish. It's not going to be like 4 50-point increases. It's going to be like 6 or 7. Or the other thing, obviously, is if the economic numbers just start to get really weak, which they haven't done yet, but it's certainly possible that they still will. Now, if you look at this, here's what's got people a little bit concerned. There's two sides of this story. One, a big part of Wall Street's argument, and all these bond traders I know that are sticking to the chart of truth, is oil. And I mean, I don't know. A lot of these guys are talking about, yeah, oil's going back to 60 or 70. I don't see that in that chart. I don't know how they're looking at that chart and going, yeah, it's going to go back to here in a couple of months. I don't think so. Maybe something comes out of left field. Maybe the Ukraine war ends, but even if it does, I don't think the sanctions on Russia go away. So I don't know where I was going to be in a couple of months, but I'm pretty skeptical it's going to be down here, and that's what's built into a lot of those consensus arguments about inflation dropping that fast. The other thing on the other side where you could get problems with metrics is this. I mean, this is basically the Michigan Consumer Sentiment Survey. They do it every month. This is the latest reading from, I think it was Friday it came out. That's the lowest since 2011. This one below is part of the same survey, and it's essentially they're asking people, is this a good time to make a large purchase? This is the lowest reading it's ever been on record. I'm one of those guys that's a little skeptical about sentiment surveys in general. I don't really trust them. I've never found that I could use the Michigan survey to get much useful information, but it's something to keep an eye on. One thing to watch is retail sales are coming out in a couple of days for U.S. See what those look like this month and next month, because if consumers really are getting freaked out, that's probably where we're going to see it first, is retail sales. And of course, here's our friend gold. It hasn't done us any favors the last couple of months. This is not, this isn't a great chart, but I don't find it super scary. Keep in mind, a lot of this drop is basically giving back the Ukraine jump, where yes, the situation's horrible. Glory to Ukraine. I hope somebody puts a bullet in Putin's head, but it's not something that's impacting the worldwide economy per se. I mean, the oil prices are, but outside of that, it's not. So it's not too surprising that people sort of got off that fear. One chart that does make me a little nervous, as you all probably know, I'm a big fan of using real rates as a guide to gold prices. This isn't a chart that makes me happy. The real rates here is a light gray and it's inverted. So this is real rates jumping way higher very quickly in the last month. That's part of what freaked the market out in general. But interestingly, gold didn't really fall. Like, yeah, okay, we had this, but in relation to that move, it's not that big. I think there's a couple reasons for that. One is that I don't think everyone trading the gold market necessarily uses the same contract. This is a 10-year TIPS, inflation-protected security. That's the one all the journalists, all the websites use. I think guys trading gold day to day, I think they're probably using a shorter version, and in that shorter version, the implied inflation rate is quite a bit higher, so the rates are still quite negative. If you looked at a 1-year or 2-year TIPS, the real yield still looks quite negative. And I'm not completely sold on this 10-year thing being right, the way things are going. Plus, I think there are people out there that recognize, and you can see it in this longer-term chart, what this shows you is these aren't recessions, these are periods of the Fed hiking interest rates. And as you can see, there's a pretty good set of correlations. There's a couple, not all of them, but most of them where you get very good rallies during a rate hike cycle. And I think the reason for that is that the market is anticipating the Fed doing one or two too many and there being a recession. Because the other correlation, if you put it on, you would find gold tends to also start rallies right at the start of recessions. And if you know how recessions get measured, you never really know for sure when a recession starts. The measurement actually comes out 3 or 6, or sometimes it's like a year later. But the thing is, if we start seeing a real rally in gold, that may in fact be a signal that a recession is starting, and you haven't seen any other data yet. I wasn't really expecting one until 2023, but with what's going on out there, I can't really discount it happening anytime, honestly. I don't think it's going to happen right away, but like I said, really start watching stuff like retail sales, anything that's near term. There's not much leading really on the consumer side, but that's really what we need to watch is, have things gotten to the point where it's breaking things with the consumer. I'm not going to spend much time on base metals, even though there's some base metal guys here, but I wanted to point this out. Copper's had a big dump in the last month of everything else, but I mean, it's still about $4. It's not like it's the end of the world. If you've been around as long as I have, $4 a pound's in Nirvana. And also, if you look at these warehouse inventories, they've moved up, but that is not historically a high warehouse inventory number. It's still quite low by historic measures. And I think almost all of this has really been due to China, due to the COVID lockdowns there. It's basically just shut things down for the last 2 months. If you look at other base metals, they've all had big dumps, and I think the big dumps in the price, that's been the hedge fund guys getting out, because the hedge fund guys were all over this stuff 2 months ago. That's all you could see anywhere. If you looked at articles and stuff coming out of hedge funds, it was all commodities, commodities, commodities. And of course, at the first hint of trouble, they freaked out and left. And if you look at almost any other commodity, you don't actually see this. Warehouse inventories have not been going up for zinc, for lead, for aluminum, for nickel. We still have a supply chain issue that I don't think is going away anytime soon. If China cranks up the stimulus, and I'm assuming they will, if they ever finally get out of this COVID lockdown stuff, I mean, their economy is in real trouble. So I'm assuming Xi's going to really, turn on the taps when that's over. That may well be enough to give us very good support for base metals, even if North America has a mild recession, because let's face it, China's where it's at when it comes to base metal demand. And really, this is the one chart that rules them all right now. You know, if you're here, you know about gold, you know about this chart. U.S. dollar has just been a steamroller for the last 6 months. It's not hard to understand why. Europe's a mess thanks to Ukraine. Japan has said they're not going to move off yield curve control. Although you're starting to see the yen come off now, and that's actually it's actually a fear trade. The yen is a risk-off currency for reasons that have never been clear to me, but it is. It's actually dropping back from 130 the last few days, and that's a measure of fear in the market. People are afraid, so they're basically hiding in it. I don't know how far the U.S. dollar goes. I mean, I don't see anything obvious to change the situation in Ukraine, for instance. I don't think that's going to end soon. So, I mean, the euro is, good chance the euro goes to parity, which means the U.S. dollar index goes higher. The one thing I can say is it's definitely getting to the point where it's starting to break things now, and that may be what makes the dollar roll over. It screws up things enough in the economy that you start seeing U.S. slowing. I mean, if you look at the last, if you look at the Q1 GDP numbers, which the market kind of took with more equanimity than I expected, honestly. Although they didn't freak me out that much. A lot of people were really surprised by the U.S. having a negative quarter in Q1. And the reason for that is like 100% connected to the dollar. It was a big drop in exports, no real drop in imports, and changes in inventory, and which subtracted from the GDP number. It really wasn't based on demand or what consumers were doing. It was strictly import, export, inventories at a commercial level. That's what drove it. But that's one of those things you start seeing when the dollar gets too high. It's starting to screw things up. I don't know it's hard to say what replaces it, so it's very hard to say where this tops, but this is a big part of the reason why we've seen the dump in gold. It's not just the correlation of one bear market. It's the U.S. dollar doing this. I don't know how much farther it goes, but it's got to top here at some point, because it is definitely breaking things. It's creating a lot of problems offshore right now. Big problems. I'm already over time, so I'm not going to go through that this much. Basically, I'm just saying what I just said. That's what you do in the last slide. So I'm going to call it there.